Everywhere you look, prices are still high. Groceries cost more, rent is higher, restaurant bills sting. Even basic services, from streaming to insurance, have crept up quietly. And yet, the economy is cooling. Growth has slowed, wages are leveling off, and consumers are cutting back. So why aren't prices following suit? Why do things still feel expensive, even as the broader economy loses steam? Let's unpack the real reason prices stay high, even when everything else slows down. For decades, we were taught that inflation works like gravity. When demand falls, prices fall too. When the economy cools, companies lower costs to attract cautious buyers. But that's not what's happening today. Instead, we're seeing a new pattern, one where prices rise fast during boom times, but barely move down afterward. Economists call it sticky inflation. And it's not just happening in one sector. It's happening almost everywhere. So, what's driving it? Reason number one, businesses have learned to live with higher prices. And so have consumers. During the pandemic and its aftermath, companies raised prices aggressively to cover higher shipping, labor, and material costs. At first, those hikes were about survival. But when customers kept buying anyway, something changed. Executives realized people would tolerate more than expected. So, when supply chains eased and costs fell, many companies didn't reverse their price increases. They simply held them, locking in permanently higher margins. You can see this in the earnings reports of major consumer goods firms. Procter & Gamble, PepsiCo, Nestlé, and others have all admitted it. Prices are up double digits from a few years ago, but volumes haven't crashed. People complain, but they keep buying. Maybe smaller sizes, maybe cheaper variants, but still buying. That consumer tolerance has become the foundation of the new pricing era. Reason number two, costs didn't actually go away, they just shifted. While raw material prices and freight costs have come down from their pandemic peaks, other expenses have replaced them. Labor is the biggest one. Wages are still rising, especially in service industries like healthcare, logistics, and hospitality. Workers aren't giving back those pandemic-era pay increases, and new hires are even more expensive. Then there's energy. Electricity, fuel, and natural gas prices remain volatile, keeping production and transportation costs elevated. And let's not forget borrowing costs. After years of near-zero interest rates, companies now face the highest financing costs in over a decade. Whether it's a retailer financing inventory or a manufacturer refinancing loans, higher rates filter through the entire economy. So even if supply chains are normal, the cost of doing business isn't. Companies are pricing accordingly, and they're not in a hurry to go backward. Reason number three, consolidation. Over the past decade, industries have quietly become more concentrated. A handful of airlines dominate U.S. travel. A few meatpackers control most of the nation's beef supply. 3 shipping giants handle the bulk of ocean freight. And in retail, Amazon and Walmart control nearly half of all U.S. e-commerce. When markets are that consolidated, price competition weakens. Fewer players mean fewer reasons to cut prices, especially when everyone's under the same pressure to protect margins. That's why, even when input costs drop, the discounts rarely make it to the customer. There's no incentive to undercut when everyone's enjoying higher profitability. In the 1990s, global competition kept prices low. In 2025, concentration keeps them high. Reason number 4, the psychology of pricing has changed. For decades, companies feared raising prices. They worried about losing market share, angering customers, or sparking bad press. But the last few years rewired that mindset. Inflation gave cover for price hikes, and companies discovered that communication matters more than the increase itself. Consumers don't rebel if you explain the rise, especially when it's framed as necessary or temporary. And once people adjust to paying $5 for coffee instead of $3.50, they rarely go back. This pricing normalization has become part of corporate playbooks. Now, instead of fighting inflation, companies are managing it. using it to test how far they can go without losing loyalty. The result? Even as macro pressures ease, prices don't reset. They just plateau at a higher level. Reason number 5, premiumization. Companies have realized that if customers are price sensitive, they can still raise prices, as long as they upgrade the product. So instead of making something cheaper, they make it fancier. Think about what's happened in grocery aisles. There's no cheap yogurt anymore. There's Greek, organic, protein-packed. In fast food, $5 burgers are now signature or deluxe. Airlines sell economy plus streaming services charge more for ad-free. In every category, companies are rebranding normal experiences as premium and charging accordingly. It's inflation disguised as innovation. Even consumers who are cutting back are drawn to treat purchases, small luxuries that feel justified. That psychology is helping companies sustain higher prices even when demand softens. Reason number 6, shrinkflation and subscription creep. Not all price hikes are visible. In many cases, the package got smaller, the service got thinner, or the subscription quietly went up. You're paying the same or more for less. Cereal boxes have less cereal. Chips have more air. Your favorite app now has an upgrade tier. This isn't random, it's strategic. Companies learned that customers notice price jumps more than size changes, so they shrink the offering instead. It's invisible inflation, one that doesn't show up on price tags but hits wallets all the same. And finally, there's expectation. Inflation doesn't just change prices, it changes behavior. When people expect costs to rise, they act in ways that make those expectations come true. Suppliers lock in higher prices. Workers demand cost of living raises. Landlords push rents higher, just in case. It becomes self-reinforcing. Everyone adjusting to a world where expensive is the new normal. That's what we're living through right now. An economy running on inertia, not acceleration. So, when people ask why prices stay high even as growth slows, the answer isn't just economics. It's strategy. Corporations have gotten smarter about pricing. Consumers have grown more tolerant of it. And both sides have adjusted to a permanently higher baseline. This doesn't mean prices will never come down. Some will. But the era of broad, across-the-board discounts, that's gone. Instead, we're in an economy where companies defend price like it's a brand asset, not a number on a tag. The real story is that inflation didn't just raise prices. It changed the culture of pricing. Businesses learned that they could hold their ground. Consumers learned to adapt. And together, they built a new normal where high prices aren't a crisis anymore. They're the cost of modern life. That's the quiet truth behind today's economy. Growth may slow, spending may soften,